I'll begin, okay? Good evening and welcome to World Investor Week 2020. On behalf of the Center for Capital Markets and Risk Management, IIM Bangalore, I, Anvesha Sinha, welcome you all. The World Investor Week 2020 is being organized by the Center for Capital Markets and Risk Management, IIM Bangalore, in association with the National Stock Exchange of India and the Securities and Exchange Board of India. Our speaker for today evening is Dr. V.R.Narasimhan. He is the Dean of the National Institute of Securities Market. Dr. V.R.Narasimhan has more than 40 years of work experience in the financial and capital markets in India. He has been associated with various government organizations like the Securities and Exchange Board of India, SEBI, National Securities Depository Limited, NSDL, and the National Stock Exchange at various phases in his career. Currently, he is working as the Dean of the National Institute of Securities Management. We welcome you, sir. The topic for this webinar is Stewardship Code. The webinar will be followed by a Q&A session. The chat window will be kept switched off throughout the webinar. Thank you to all our online viewers for joining us. Thank you, sir.
Thank you, Anvisha. I thank National Stock Exchange, IIM Bangalore Center for Capital Markets, and SEBI for giving me this opportunity to speak on an interesting subject called Stewardship Code. Stewardship Code is a very interesting and very powerful initiative that SEBI has taken in the recent past. And I thought that all the investors and academicians and onlookers who look at the capital markets closely should know something about the Stewardship Code, and therefore this topic is being brought before you. I have a presentation to make, and I will be guided by the presentation. I will show the presentation on the screen for your benefit. The presentation, I would like to take you through why this Stewardship Code, what did SEBI say in its circular, how did the market implement the Stewardship Code as required by SEBI, are there any lessons from insurance industry, because insurance industry has got about 2 more additional years of experience. They brought in Stewardship Code in 2017, and therefore are there lessons to learn from them? And while implementing the Stewardship Code, there are several sensitive issues which one should be aware of, and how to make this stewardship practice effective are the various things I would like to cover as we go forward. As all of us understand, when our investors invest into mutual funds, or they take an insurance policy, whether it's a general insurance policy, whether it's a life insurance policy, whatever, these monies finally find way into equity shares of various companies and debt securities of various companies. Therefore, welfare of those companies is a definite requirement for all those people who indirectly invest into these companies. While direct participation in the equity shares, one becomes an equity shareholder, and therefore he may exercise his own ownership or equity rights. When we take the route of mutual funds or institutional investor route like insurance companies, etc., we empower our professional fund managers to represent our interest in that company, and they need to exercise such interest. That way, all the 7 crore folio or 9 crore folios, I mean, even assuming that every investor has got 5 folios in the mutual funds, so we are looking at not less than 1.4 crore persons, individuals interested in the equity shares in this various companies in this country. And mutual fund managers, insurance fund managers are actually taking care of their interest by representing them in the mutual fund companies, general body meetings, etc. Are they doing what they are supposed to do? As equity shareholders, they are owners of the company, and ownership brings certain responsibilities and rights. Rights we are aware of. responsibilities are we exercising? As we exercise more and more of our responsibilities, I am sure that the corporates will behave better and will have a sustained corporate performance, and we can look forward to higher valuations in the companies. Just to give you an overview, whereas private promoters hold about 34.2% of, on an average, I'm looking at the national averages, 34.2% of the companies are is owned by promoters. Domestic mutual funds hold about 8%, insurance companies hold about 6%, retail 8.7%, and foreign portfolio investors others about 20.2%. Now look at the way the retail investors 8.7%. It's a different topic altogether. The point is the retail investors, mutual funds, and insurance company, if they come together, they can be a potentially a good, what you call, party general body meeting to question decisions taken by promoters if they are not seeming to be in the interest of the company or for the long term interest of the corporations. But then if these people do not participate in the general body meetings, if they do not engage with these companies, the promoters will try to run the company the way they would like to, and to that extent there's no point in trying to cry saying that, oh, they are not working as per the long term interest of the investors. Investors also have a responsibility that has to be exercised. That's the reason why steward is a person who looks after another's property. As a steward, you have got some responsibilities, and the stewardship code deals with what kind of responsibilities the stewards, namely mutual fund managers and insurance agents, insurance companies, are expected to exercise. I mean, equity investments, in case you want to protect the value in the equity investments, you need to protect the value embedded in it by taking certain actions. Those actions are actually a stewardship responsibility, sum and substance. Retail owners, we have seen, actually we have done a small little exercise in the meanwhile. We have seen that during this current year, all the general body meetings were done in a virtual mode, wherein people could have joined the general body meetings from the laptops at their own convenience of their home. But amazingly, stunningly, we found that attendance at general body meetings during this year was half of what it was in the last year, which was a physical meeting. That shows the general apathy of the retail owners, or often they are not even competent enough to even question the decisions or understand the complicated resolutions being proposed by the company before general body meeting. So either because of the apathy or because of lack of competence, retail shareholders cannot be expected to do much. Whereas the domestic mutual funds and insurance companies, being professionals in their own rearing and then in their jobs, they know and they understand what these companies are up to, and if they are not in the interest of the company, they can raise a question, they can seek clarifications, and they see that the companies are performing well. It actually, when you look at the corporate governance issues, very simple statement I would like to make is that corporate governance mishaps happen because the managers, corporate managers, when they sit in the chairs, they think that they are the owners of the company and all the resources that the company has are their own resources, and they start using those resources as if they are complete owners. They forget that they are only fiduciary officers to take responsibility on behalf of all the owners, and they have to run the company in the interest of all the shareholders. Instead, the management generally tends to run the company in their own interest, which may not always converge with the requirements of the shareholders at large. That's the reason why you find all corporate governance mishaps that are happening, and that can be put a check upon only by active participation by the shareholders. And that's the reason why stewardship code, the initiative taken by SEBI, is a very interesting, powerful, and useful one. We only have to see, wait and watch how this stewardship code evolves over a period of time, and whether the domestic mutual fund and insurance companies are actually have made any difference to the corporate governance processes in our country. What happens is, if you club the total shareholding of insurance companies and mutual funds together, it is coming up to some 12-13%. 12-13%, that is crossing 10%, has got a lot of value from the corporate companies act point of view, because The moment they have got more than 10% shareholding in the company, they can do a lot of wonderful things in terms of asking the company to move some resolutions, in terms of asking company to add certain agenda items, raising questions, and so on and so forth. And therefore, we believe that wherever promoters are not acting in the complete interest of the shareholders and stakeholders of the company, these institutional investors can potentially play as a counterforce. At least they can start seeking explanation. As the institutional investors start monitoring and seek answers for their questions, it puts a sense of responsibility on the management of the investee company, and from there onwards you can see change in the behavior of the investee company. That is essential pith and substance and or the goal of the stewardship code. And then if the institutional investors, they take intervention actions, if they intervene into the corporate governance process by scheduling a meeting, asking for clarification in public from these companies, promoters, they will not taking any adventurous decisions. For example, a merger decision or a demerger decision or a capital expenditure decision, etc. If it is adventuristic in nature, it is not in the interest of the company, or there's a lot of uncertainty loaded in that particular decision, then in such cases, if these institutional investors raise questions against it, they will see, oh, this question, they may ask a question to us, let us not take this adventurous decision. That's how a check will come on the promoters of the company, and that will be a very good augury. And then, in fact, the Companies Act of 2013 has a very interesting provision, especially with respect to related party transactions, etc., where the minority can decide an issue. That is, promoters and others who have got interest in the resolution, they cannot participate in the voting of the particular resolution. Their majority, the minority will matter a lot. That is, within the group, other than the promoters, we are talking about some 65% total shareholding. In that, we don't expect FPA to participate so actively. So institutional investors, if they exercise right, since retail investors anyway do not participate, they can take a decision whether this particular resolution should go through or not. Therefore, this majority of minority principle also will help a lot in terms of giving a lot of power to the stewardship responsibility that the domestic mutual funds are expected to exercise. That's a beautiful initiative, and therefore we are supposed to we have to wait and watch how this stewardship code will actually evolve, and how it will actually change the shape and culture of our corporate governance in our country. And then the stewardship code, actually, I mean, I can talk any amount of time on the kind of issue that can actually be questioned by the institutional investors. For example, a company wants to spend a capital expenditure. What is the quantity? What is the timing? A timely implementation of the project? Is it being effectively utilized? Who is the vendor selected, etc.? Each of these areas are an area where corporate governances can be compromised, and therefore institutional investors can raise a question. Similarly, we have seen several instances where a company in India invests either a debt taken from a company or equity of that company into equity of a subsidiary outside the country. The moment they invest into equity of outside the country, the asset and the activity of that subsidiary abroad will be going out of the jurisdiction of Indian country, and we do not know what will happen there, and there could be lack of transparency. Actually, it could be completely what you call oblique. We may not be knowing anything about it. It's quite possible that after 2 years they say the subsidiary company in the foreign has now got into liquidation, and they'll be write off the whole money. Is it really write off? Is it a siphoning off? What exactly is happening? How do we look at it? That's a question probably the institutional investor can ask right from the beginning, not after the company has invested outside. At the time of proposal to invest abroad, they can raise appropriate questions and see that if the investment is not good enough for the country, they could stop it. That's one thing. And then board and board level executive selection, compensation, performance, any number of questions can be raised. Actually, if you go to stock exchange sites, you can see the number of questions raised by stock exchanges on appointments in terms of details seeking, etc. There are areas and areas. There are occasions where a director has not attended the board meetings for more than 50% of the times. but still is as coming for reappointment. Should it be done? We see that promoters would like to take about 90% of the total remuneration payable to the managers. Only 10% is being given to the other management personnel who are other than promoters within the board level or one level below board. Is it reasonable? A lot of questions can be asked, and there's a need to ask such questions. On the mergers, demergers, acquisitions, valuation of the assets is a big area where a lot of questions can be asked, and these questions can be asked only people who understand the business very well, which is actually fund managers, which is actually who are the investment managers of insurance companies, and the right people who can actually evaluate and take the right kind of questions before the promoters. Capital structure changes in capital structure can alter the authority of the existing security holders. Let us say they try to convert so many warrants into equity, it means that the power of the existing equity shareholders will get diluted. So you try to go in for buyback, you try to convert some equity, this will actually capital structure re-engineering. It can alter the rights and powers of the existing shareholders, and whether it is a good interest of the company or not is a question to be asked. I'm not saying everybody is doing wrong. What I'm saying is there are areas where some questions have to be asked, and to ask the question there should be appropriate empowerment, and institutional investors are knowledge-wise empowered. They have, if they act collectively, they are even rightfully empowered under the law also to ask right questions, because they constitute more than 10% of the shareholding. And that's what I'm saying, that they can do a lot of things. Financial performance is a question area which can be questioned every time, or which requires scrutiny. And disclosures, adequacy and timeliness. Suddenly companies have want to borrow, suddenly companies say I want to buy back, suddenly companies I want to withdraw the buyback. So many things are happening. So whether these disclosures are adequate, are they giving the full information or not, all these are questions which require to be asked. Unless somebody is there to ask questions, you will not get the answers. Unless somebody is seeking clarifications, promoters may try to behave the way they want to. All this can be put into proper light, and see that always stakeholders interest is well protected when you do this, when you use this stewardship code the rightful way. So that's why there is no doubt why stewardship code is required. In fact, the stewardship code movement has started somewhere in 2012 in the UK. First time UK has given stewardship code in 2012. Eventually all countries followed, and today UK has issued stewardship code 2020, which is one step ahead of stewardship code. The stewardship code that we have today is only initiating principles towards doing certain things, whereas 2020 principles of UK stewardship code, they are outcome oriented. They are also seeking outcome of the stewardship that they are trying to do. That's a beautiful way of evolution. We also have to see, we are just about 9 months old in our country, the stewardship code. Most of the AMCs have adapted it. They put them into effect from July 1st onwards, and let us see how exactly it's going to go as we go forward. I mean, what happened was, before the stewardship code came into existence, mutual funds were obligated to vote definitely in all the general body meetings in which they hold equity shares of various companies. This particular rule is effective from somewhere from the 2016-17, and we did a study at NISM as to how the mutual funds are actually voting. Thankfully, the mutual fund voting pattern, their voting policy, etc., are to be publicly put up on their websites. We went to all their websites and we studied. We found that 87.54 times mutual funds voted for the proposals put up by management. 3.93 or 4% times they voted against them, and about 9% of the time they abstained. I'm surprised, why should they abstain? I mean, how can a professional manager not have a view on a particular idea, either vote or for or against? But you find that number of times they vote against is about roughly 4% times, whereas abstinence is about 9%. Is a very surprising study, and 88% of the time they have been voting along with the promoters. I'm not saying voting for the management is bad, even for a minute, but we only hope that they have evaluated why they are doing what they are doing, assuming that they have done a professional exercise at the time. I still can't understand why they have to abstain 9% of the time, is one question. When they abstain, what happens is, as per the rules, the abstention actually will strengthen the hands of the promoter. So 87.454% times for will be actually read as 87.54 plus 9%, 96%. They can say that it has gone in favor of the promoters. So what are we trying to do? That's what exactly the question. And then we have also seen that while voting policy was stating something, actual voting pattern was different. To give you two examples, when voting policy says that when in conflict, abstain. That's what they say. They say they had they have a question. The mutual fund is not clear whether they have to vote for or against. They're in a conflict of interest situation. I have a lot to discuss about it later on. And as per the policy, they say abstain from voting. But in reality, we have seen certain companies have voted for the promoter company, where the policy says abstain. What are we doing? You stated a policy, you're not even going by your own policy. In another case, in some other case, we have seen attendance in the board meeting should be considered as a factor for voting a person for election of director or not. Whereas attendance criteria is an important criteria from the policy point of view, the mutual fund went and voted for the candidate, even though the candidate did not attend himself for more than 50% of the times in the board meetings earlier. What are you doing? You're not consistent with your voting policy. And therefore, there's a need for us to press on the mutual funds to see that they will behave even better, to see that they stick to the policies they themselves have enunciated. And another thing is that we have also seen that different mutual funds voted differently on the same topic. Let us take the example of this board meeting criteria. Somebody is not attending the board meetings. Some mutual funds have voted for the candidate. Some mutual funds have voted against the candidate. I'm surprised. If the professional view is taken, I feel that all the professional views should be more or less converging into the same thing. Against an objective criteria like attendance in the board meeting, we find that even that is also not there. There is a lack of coordination and collaboration among the mutual funds. Something has to be done about it. And then my observation is that the voting policy disclosures, etc., is taken as one more compliance point rather than taking it seriously in terms of using it for better compliance corporate governance. I only hope and wish that the stewardship code, when implemented, as being implemented, will be bringing in a lot of seriousness among the mutual funds to see that the corporate behavior or corporate governance is in the long-term interest of the investors. Okay, SEBI has issued a circular saying that now, my dear friends, it's not enough if you have got voting policy, you go one more step forward. There should be something like a stewardship policy. Now, what does the stewardship policy say? The stewardship policy that we have in our country is more or less on the same lines that the international stewardship policy. That is, all of the jurisdictions also have stewardship codes, and our stewardship codes also more or less on the same lines, the same 6 principles, etc. And then the SEBI circular defines stewardship responsibility as the institutional investors' responsibility. And they also say that it is beyond voting. It's not just voting alone. You may have to do certain things even beyond voting. For example, insurance companies, AIFs and MMFs. I should here point out saying that SEBI, IRDA, PFRDA, all these people have came together, sat together and created this stewardship code. And they created more or less the same kind of stewardship code for insurance industry and mutual fund industry to see that they can contribute to the corporate governance in investee companies. That's the reason why they have done it. And then it is based on 6 principles. The point I'm saying, the important point to note is that every mutual fund is expected to define its own stewardship policy. I mean, there are 2 options before SEBI. One, this is the stewardship responsibility, please follow it. Instead of that, they said each mutual fund should define its own stewardship policy. There's a lot of meaning behind this. Reason is, there could be a mutual fund which is more debt oriented than equity oriented. There could be a mutual fund which is more equity oriented than debt oriented. There's a mutual fund whose sister company is a NBFC, whose sister company is a bank, whose sister company is an insurance company, and so on and so forth. These structures bring in peculiarities in each of the mutual funds in its own way. Let us say you have insurance company who predominantly invests into debt instruments and not so much into equity, and a mutual fund you invest more into equity. When you try to exercise your votes, when you try to exercise your stewardship responsibility, as a debt owner, you have different type of obligations and rights, and the equity owner, you have different type of rights and obligations. Do they match with one another? How do you want to do it? So therefore, they left it to the best judgment of the company, mutual fund concerned, to formulate its own policy to suggest its own way of handling these kind of situations. And that's the reason why liberty was given by SEBI to individual mutual funds to define their own stewardship policies. And the 6 principles are said. There's no, I don't, at least when am I reading of SEBI circular, it doesn't say that you should start with only 6 principles, but the 6 principles are minimum. There could be more than 6 principles if necessary. But my observation is that most of all the mutual funds have started with only 6 principles. So what are the 6 principles you are talking about in the SEBI circular? SEBI circular talks about 6 principles. One is that every mutual fund should have a policy of its own to fulfill the stewardship responsibility. Point number 2 is that they have to have a framework to identify and manage conflicts of interest while discharging stewardship responsibility. I have something to discuss about this going forward. Monitor the investee company, and while monitoring, you have to understand what are the areas to be monitored, when to monitor, etc. That's again it's important, and it also very clearly says that while you are being given the responsibility of monitoring the company, it doesn't mean that you go and sit with the promoters and take the unpublished price sensitive information and indulge in insider trading. That's very clear. It is stated that take all these monitoring steps, but steer clear of your UPSI. Then intervene with the investee company as per your monitoring outcome. If the monitoring says that there's a need for you to intervene with the investee company, do it. Either you interfere yourself, or you interfere along with your mutual fund colleagues, other institutional investors, and go and represent to the company in a way that there is a change in the corporate behavior that you can do. You have to have a policy on voting and disclosing voting patterns, and to be made public, you have to tell the public saying that this is voting policy, this is what I have done, this is what I want to do, etc. And finally, you have to have an obligation, to disclose how did you discharge your stewardship responsibility. Fairly comprehensive in that. It's a pith and substance is monitor, intervene. Monitor, intervene, the pith and substance of stewardship code. And with this, probably you can put the companies into check if required. It doesn't mean that it should be obstructive. It doesn't mean that it should be coming in the progressive path of the company. At the same time, it means that you have to exercise your precaution. If you have to wear a helmet while riding the scooter, it is so. Helmet is a burden on your head. It doesn't mean that it's a problem for you. It protects you, and therefore stewardship responsibility is something that you've got to do to protect the interest of your own investors. You are representing others' wealth, and asking right questions bring in a lot of corporate governance standards in your company, and therefore do it. That's what exactly SEBI circular says. Now, what I did is, okay, fine, we have got stewardship codes and it has been initiated. Let us see how various mutual funds have tried to implement it. What did they write in their policies? What are the variations? What are the good points? And what are the points where improvement is required? That's the reason why I have done some survey. In the survey, I have taken some mutual funds which are highly domestic, which are having some foreign owners with it, which are large in size, and so on and so forth. Therefore, I've taken this BNP Paribas, DSP, HDFC, ICICI, Invesco, Kotak, SBI, Sundaram, UTI. The mutual funds, this is what I have studied their policies to understand what they are. My understanding is, in a mechanical way, most of them have 7 pages long. It's very accidental that all of them have only 7 pages long of stewardship policy. It means that the source of the policy drafting is same, more or less. One company had 5 pages, another one 10 pages. Take the title page and thank you page, then becomes same number of pages. The sequence, wordings, conditions given in the SEBI circular are more or less incorporated in the company. In fact, if you run a plagiarism software across all these policies, I think 70 to 80% will be plagiarism, will be the result that's coming out. That's what exactly. I have no complaint that they are copying me from another or they're copying from the circular, but at least we should see elements of originality to suit the specific requirement of a mutual fund. That's where I'm trying to search, and I'll come with my observations as we go forward. And peculiarly, while many of them have not defined why they are putting stewardship code in place, almost everybody said that we are implementing the stewardship code because SEBI wants it. That is, stewardship is not taken as their natural responsibility. Stewardship responsibility is taken as their compliance obligation. That makes a huge difference. Why does the police run and why does the thief run? There's huge difference. Police is running for salary, thief is running for his life, and therefore the speed with which each one will run will be different. Here, somebody is saying I'm doing it for the sake of compliance, the interest level you can understand. If they are doing it for seriously for the sake of stewardship, obligations, and what you call protecting the value in the investment, I think stewardship will evolve in a totally different way. That is my view. Now I've just seen all this and I wanted to see whether they have defined their objectives in their stewardship policy. I've studied all of them. Most of them have not stated their objective at all. When mentioned, they tend to say that we are doing it because it is SEBI circular and therefore we are doing it. I'm just trying to give you some wordings here and there. I've given 3-4 bullets. You will see that it's all more or less like, say, reflecting what SEBI wants them to do. I would feel that if they have got a clear-cut statement of objective, it helps in giving a clear direction for those people who implement the stewardship code. Let us assume for a while that a committee of 2 or 3 officers responsible for implementing the stewardship code, had they given a statement of objective in clear-cut terms, I'm sure that those people who are responsible for implementing the code would have a clarity in terms of how to take the steps required. But since they have not mentioned, the committee or the person responsible for the stewardship code has to actually evolve an objective for himself and take it forward. And if the officer changes, the objectives will change. Therefore, it will not be an institutional mechanism for administering the stewardship code is my concern. And therefore, I would recommend that all the mutual funds should have their own clear-cut defined objective for stewardship code. That will help everybody to discharge their responsibility better. And then the ownership and responsibility for stewardship code, they say it's a board approved policy. Board does not come every day. It comes once in a quarter only. The board, if the mutual funds have a tendency, for that matter, all companies have a tendency, not less than 4 company meetings per a year, they do only 4 meetings. Not less than 6 meetings a year, they do only 6 meetings, irrespective of whether there's a need or not. So that's how board is, the board approved policy, but how much board will be able to monitor this is a question. Anyway, different mutual funds have different views. Somebody said it's an investment committee responsible for stewardship code. Somebody said stewardship team or stewardship committee will take the responsibility. Somebody said voting committee will take the responsibility. One mutual fund said there'll be a stewardship officer. And then only one AMC out of the one I have monitored, they said only one AMC mentioned that audit committee will oversee the review. That is, none of the other companies, other mutual funds have said that audit committee will review the stewardship implementation. Only one AMC mentioned it. And another only one AMC said that there will be compliance officer will check whether stewardship code is strictly complied with or not. I would say that should the adherence be viewed from compliance perspective or involvement perspective is a question. I would believe that the mutual funds should take the responsibility to see that they exercise their stewardship responsibility in a manner that the wealth in the company is protected, rather than saying that, okay, I have complied with the requirements of SEBI. That is, SEBI will come for inspection. When they come for inspection, I've got documents to prove that I have done my stewardship activity. That's not the intent behind stewardship code. It's letter and spirit, form and substance issue. I think in substance, they should be more serious in terms of implementing stewardship code in order to preserve value of their equity and also to see that the corporate governance standards in our country will grow. That's what my view is. Now, the principle 2, which talks about engaging with the investee company. SEBI has given a lead while drafting the circular, says that engagement may be related to investment. That is, if I have lesser investment, I may not want to engage so much. I have got more investment, I may want to engage more. Most of the mutual funds have taken this lead and incorporated, saying that all mutual funds say that investment, the engagement with the company will be depending upon the threshold, but threshold is not public. Nobody has mentioned what the threshold is. Say, if a mutual fund is having 100 crore equity and average investment in a company is about say 1 crore, do you say that 1 crore is a threshold? And if the 100 crore becomes say 2000 crores, will this 1 crore stand as a threshold even going forward? There's no such statement at all. And why should it be threshold oriented? Assuming that the mutual funds believe the stewardship code as a serious activity and they want to collaborate with other mutual funds to see that investment value is preserved, why not they work on all the companies in a collaborative fashion every time? Why am I saying this is, today I'm invested 1 crore rupees in this company, but going forward as my aim, assets under management, they will increase. I may want to invest more and more into this company. As I invest more into the company, what was not eligible for engagement earlier suddenly becomes eligible for engagement. Do you want to engage it at that stage? You want to cure the cancer as it is discovered the first time, or you do not go for testing at all? You'll go for testing only when you find serious symptoms where you are already cancer prone and doctor says I can't do much about it, you live with it. Is it the way you want to work? That's a question. And then level of management engagement is related to the extent of investment but not defined. Again, what level of engagement will you do? Engagement means what? Writing a mail, talking to them, meeting them. What is that you want to do? That is not exactly stated anywhere. And generally, the intent that I've seen is that they would like to engage based on the amount of investment they made. I'm not very comfortable with this situation. They need to have. One AMC has written a very beautiful statement saying that our engagement will be topical or a practical situation. That is where we think we can make a difference to the processes, where we think they can be an outcome of our intervention with the company. We would like to engage. When we think that we are not going to make any difference to the company and therefore we don't want to go that side at all, that was one way. Topical, that there be one area where it's completely company's prerogative, where we don't want to engage at all, and there are certain areas where we want to engage because it matters to the corporate wealth and therefore our wealth, they want to engage. That's a beautiful way of saying it. That's again meaningful. And then some one mutual fund said it should be meaningful engagement and possibility of success will guide us whether we want to engage with them or not. And some AMCs take a view that in case I invest in a company in a passively managed fund, I will not engage with the company. Again, I would say that proactive engagement by investors that matter is critical for sustaining the value. You should be proactive, not necessarily reactive. That is, you don't have to wait until something bad happens. Proactively, if you think there's a need for you to interfere or say engage with the company, do it irrespective of threshold. Maybe you want to collaborate. You want to ask a senior. Let's suppose in a company I've got 1 crore investment. My colleague AMC is having about 10 crore investment. Talk to the 10 crore guy and say, my dear friend, what do we do with this case? He may say, oh, is it so? We'll work together. The moment 10 people are looking at the same company from a different points of view, I'm sure that that company will sit up and say, oh, I'm being watched. Let me be careful. That's what I believe they should do. And then how do you monitor? What is that you're doing for monitoring? Every stewardship code that I've studied says that we will go by publicly available information, sell-side research, research report, etc. We'll attend the conference calls called by the management, etc. So, and then we would like to monitor to ascertain the strategy, performance, risk assessment, capital structure issues, etc., etc. That's what they said. My observation is that the list of items to ascertain slightly varied, but more of them, all of them are same. All of them have said the same 5-6 items that I have listed above. But how do you monitor? What tools you will do? What does actually step-by-step monitoring will do? Nobody has spelled out. This is the area of concern for me because unless you do certain things while monitoring, what do you mean by monitoring? Monitoring is looking at with what perspective? When if you go to an exhibition, all of us go and watch the same drawing or a painting. Somebody buys, somebody doesn't buy. What does it mean? A person who's buying it has seen certain beauties in that particular painting and therefore is picking up. Other person who stood before it, he has also seen it, but he has not seen anything good about it, therefore he did not pick it up. Similarly, you could watch. Balance sheet is watched, shareholding pattern is watched, announcements are watched, and annual general body resolutions are watched. But what did you see in that? You watched them, but you have not reacted to them. Therefore, you need to look at what exactly it is, and you have to break it up and see. I would like to see every resolution from the point of view of law, from the point of ethics, from the point of corporate governance, from the point of value preservation. Do you have these kind of attacks with you? That is what is required, but none of these. Whereas in insurance industry, we have seen some more elaboration. Whereas in the case of mutual fund industry, we have not seen that kind of an application in terms of saying what is involved in monitoring these companies. That's not clearly said anywhere. And they also said that it is a part of investment team's responsibility. I have again a question here. The investment manager, fund manager, looks at his investments from a different perspective, and a person who wants to be guarding the investments, he will look from a different point of view. That is, I mean, I'll give you a very crude example. Let us say there's a security guard for a property and a property owner. Property owner will go and look at the property and say, oh, this is fine, this is fine, this is a beautiful point, and so on and so forth. Whereas security guard will see whether the property is secured or not. He may not go inside. That is, the investment manager will look at from the value perspective, whereas a stewardship officer will look at from the point of view of value preservation. These two are totally different. An investment manager may still be investing in a company so long as he finds an upside to the value, whereas a steward officer will say, I will not invest in this company when he feels that the value may not sustain. I think there's a huge difference between these two, and therefore my personal view will be that stewardship should be possibly a separate function, a specialist function, especially when the company is investing into hundreds of companies. Assuming that a mutual fund is having about 25,000 crores of equity investments, invested in about 350 companies. The investment manager has to monitor 350 companies day in and day out from the point of view of what is happening, what is the impact of various announcements, economy, etc. on the company in terms of value. He has to buy or sell. He has to keep on looking at that perspective. Whereas the stewardship officer will see what is the kind of decisions taken by each corporate. Is it good for the company or not, is what he has to look at. I think the way you look at it is different. But most of the cases, they said that everybody said that it's the investment team's responsibility to do the stewardship responsibility also. But I think there's a need for considering this as a separate responsibility altogether. And then most of the AMCs said we may take this as help of a third party for analyzing the stewardship responsibilities. That's of course their strategy. I have no comment on that. On the intervention side, again, they said we will interfere only when we have got investments which are significant in value. And then some AMCs, 2-3 AMCs said we would like to see from environment, society, and governance point of view also. We would like to see if the company is not behaving well on the ESG perspective, we may want to interfere into them. One AMC said that we would like to have moderated intervention, high level intervention, moderated level intervention, low level intervention, depending upon the extent to which we are invested in the company. And in all cases, the investment was supposed to be on case-to-case basis and best efforts basis. The moment you introduce these two words, case-to-case basis and best efforts basis, the seriousness of the whole process will be substantially reduced, is my personal view, but this is what exactly people have said. And then intervention, how do you interfere? We will interfere through communication. We'll write to the company, we'll talk to the company, we'll discuss with the company, we'll discuss with lower level, middle level officers, functional officers, and we may have to go to the board of directors. We may want to talk at the general body meeting. We may want to vote in a particular way. We may want to do so many things. That's different. Engage with the company will be in a different way. Generally, they said we start with communication, then we'll collaborate with our colleague AMCs, then we'll escalate to the board of directors of the company, and finally, in case nothing happens, we may go to regulator to complain against the company or raise a question. Regulator, when I say it, not necessarily SEBI, it could be MCA, it could be rather raising a resolution or so on and so forth. So that's what they said as far as the policy and intervention is concerned. Some AMCs have said, in case after intervention, the company is not going to listen to us, we'll vote against them, or we may institute a legal case against them in case we find that our interests are jeopardized badly. And third case, in some cases, they said, if the promoters are not listening to us, we may have a blanket ban investing in the company, not only in this company, but in all the companies in which the promoters are the managers. That's different levels of intervention, but there's a good direction in which they would like to go. And then only one among all the boards, AMCs have recognized that they have the ability to move resolutions at general meetings once they collaborate. Only one AMC has recognized, none of them have recognized. The point is that uh, the trigger for intervention is not specified in clear-cut terms. If there's a clarity, there's always good for everybody. And then there's no different defined linkage between type of intervention, extent of concern. That is, will you engage with the board of directors if the investment is foreign subsidy investment is made? Will you engage with the board of directors if the performance is bad? How do you exactly intervene? What is the relationship between the trigger action and the level of intervention? That is not clarified anywhere. If that is clarified, I think it's going to be a huge difference as far as the stewardship effectiveness is concerned. I would definitely see that intervention is the most powerful device to discharge stewardship responsibility. And if they actually intervene more frequently, I'm sure the corporate governance in the country will be of a totally different quality. As far as collaboration with other companies are concerned, other institutional investors are concerned, most of them have recognized that in case we act together, whether we'll be caught under the takeover code of saying that we are acting in concert, I believe it will not be so, because SEBI also has encouraged collective action, and collective action not for the purpose of taking over, but to set right the corporate governance process cannot be considered as acting in concert. Therefore, that worry should not be there, and all the institutional investors should come together, and if they are able to collaborate and work, that will be very good. All of them have said that we would like to go by collaboration case to case basis and on threshold limit. I am actually surprised at this statement, because I may be invested lesser amount in one company and more amount in another company. My counterparty AMC, my other sister AMC would have done exactly the opposite. So what does it mean? If we collaborate for all cases, the collaboration will be powerful, because the sum total interest of AMCs in the company is equal. But then in one case 6 AMCs represent, in another case 3 AMCs represent. I do not know how far it is correct, because one AMC will say, you did not participate with me when I asked you for the last company. Now you are asking my cooperation, why should I do it? This kind of differences will emerge, and therefore I would say that collaborative approach should be a universal approach. It should be a regular approach. In all the companies where equity investment is made by companies, the mutual fund, they should work together to see that there is a collective representation before the management. Only one AMC said that collaborative approach is not only cost effective, it is efficient and potent, as well as is likely to deliver the desired result. Only one AMC has recognized this particular power of collaboration. I'm sure that SEBI code itself has encouraged collaboration, and therefore PAC may not be an issue there. And mutual fund should recognize collaborative strength as given under the Companies Act. They can pass resolutions, so on and so forth. That's I feel that collaboration with other institutions need not be on a conditional basis. They should work together. I would feel that they have mutual funds already have AMFI, a industry body. Within that industry body, they can have a division for collaboration under this stewardship code. That itself can be a very good answer, because AMFI is anyway a collective industry body. That's my view is. That can make a huge difference to the country's stewardship responsibility. And conflict of interest is one area which is actually an important area to be understood. Conflicts will happen because individual mutual funds, officers within the mutual funds may have some conflicts with the investee company. For example, investment fund manager in one mutual fund and his brother is a managing director in the company, investee company. Will this fund manager be able to take a strict action against his brother managing director is a question. So therefore, either because of the individual fund managers, or because of the relationship between the AMC and the company itself, or because of the observation is that most of the mutual funds in our country are part of financial conglomerates. Being part of financial conglomerates, I'm sure that these financial conglomerates will have a complicated and a cobweb of relationship with other corporates in the country, and therefore that may be itself leading to certain types of conflicts of interest. So how do you handle the conflict of interest that you're having? The definition, the identification process, the solutions offered by all the mutual funds are more or less as given in the SEBI circular itself. I would say that they should identify the conflicts of interest a little more rigorously, and they may have to have a concrete solutions for them to handle the conflict of interest. Unless they address the conflict of interest issue very clearly, it may be very difficult for stewardship code to be exercised. Had this been very strictly implemented, certain mishap that we have seen in the recent past mutual fund industry may not have happened, is my personal view. And then they have given, actually they have also given some suggestions as to how do we do it. Most of them have gone by solutions offered by the SEBI circular itself. One AMC said we'll maintain the conflict of interest register. Somebody said that whenever there's a conflict is arising, we will try to take the best interest of the unit holders. Some people said investment decisions will be segregated from voting decisions. Some people said Chinese wall between voting department and the investment department. Some people said we'll document the reason why we have acted in a particular way whenever we find the conflict. I would say that disclosures and documentation are the most advisable way in which the conflict of interest can be handled. Disclosures, yes, everybody said they would like to disclose their policies and voting policy, etc., reports on the website. Some have said that they will inform the unit holders once in a year in the unit holders report. Most of the as required by SEBI, voting outcome will always be disclosed on a quarterly basis. Some AMCs said that disclosures before being disclosed will be vetted by compliance officers. And then one AMC went forward and said we would like to make the disclosure in a way in which investors can is easy to understand format. That's again a beautiful way of saying it. But then my question is, if they have intervened into the company, why not they disclose about intervention as and when they interfere instead of waiting for the end of the year? Because until the end of the year, it doesn't make sense at all. If you disclose as and when the intervention happens, it will be very helpful, because the investor who has invested through the mutual fund may be a direct investor also. Then he will understand what to do with the company if they have invested directly, and this can give a very good signal to the market as well. And therefore our recommendation will be that they will have to disclose as and when the events happen. That's the recommendation, but anyway, some disclosure is happening, that is fine. As far as insurance company is concerned, their policies have been little longer than the insurance company, mutual fund industry. They have been 13 pages in length. Almost every insurance company had 13 pages. That's what's actually perplexing for me. And then the principles are the same. Only difference is that I've seen they have given some standard operating procedures, and they have given some more granular approach to the implementation of the policies. That's the beauty of what insurance companies' stewardship policies have been stated. I feel that there are certain sensitive issues which have to be handled well, and then certain steps to see that conflict of interest policy is well managed. What I feel is that whether if they go for a collective approach or collaborative approach, there'll be allegation of persons acting in concert. My feeling is that no, but it's always good that AMFI or mutual funds together request SEBI to clarify on the issue. My gut feeling is that since they are not acting in concert to take over the company, the question of persons acting in concert question or concern may not be existent at all. While dealing with the company and interfering and engaging with the company, it's quite possible that insider information may be passed on to the mutual funds. Therefore, they have to be careful. The discussions they do with the company should be disclosed, or they should schedule the meeting with the company, and the schedule should be publicized well in advance so that nobody can allege about having insider trading, UPSI exploitation. And there will be conflict of interest between schemes, conflict of interest between sister concerns. What is required is matured handling. And one of the RBI reports on conflict of interest, earlier ones, I think the 2012 or 13 report, an excellent report. What it says is that disclosure is the best antidote for all conflicts. I would say that disclosure should be taken as a priority item wherever they find a kind of a conflict, and proper documentation should be kept in hand so that nobody can allege that conflict of interest is the reason why a particular decision is taken. That can always be handled. And then since fund managers will always look at value perspective, stewardship is not necessarily value perspective but ownership perspective and sustaining a long-term relationship. long-term value purpose, I would feel that going forward, there should be segregation between stewardship responsibility and fund management responsibility. And not only that, stewardship responsibility can be separate, carved out as a separate job, because every mutual fund would have invested into hundreds of companies and each one has to be studied in a different way. A steward responsibility would mean understanding the law, understand the business models, understanding the background of a particular resolution to be moved, etc. And therefore, stewardship responsibility, if it's carved out and given to a separate department, may be good. That's what my personal belief is. And then stewardship code adherence should be given, oversight responsibility should be given to either board committee or a separate, a higher level committee within the managed executives. That will be good, so that stewardship officers or whoever is responsible for stewardship will try to exercise extra caution while discharging responsibility towards stewardship. And then one interesting observation is that if a mutual fund is engaging with a company, should it be investing in that company or not? The point I'm trying to say is that yes, if you are engaging with a company, it doesn't mean that you should exit from the company. Your intervention may be for improving the value further rather than negating the value of what you already have. The company may be having an inherent value already which will grow up, no doubt about that, but certain steps taken now may accelerate the value accretion in that company, and therefore encouragement may be for such value accretion rather than a protection of value at that point in time. So there could be positive interventions, negative interventions. Therefore, interventions and investment decisions should be segregated, and they can take a view depending upon how they would like to do it. And then a last slide is, how do I improve the effective? How do I make my stewardship effective? I'm saying this because I'm sure it's a matter of time. In 1 or 2 years, all of us who are observing the mutual funds and institutional investors, regulators, press, everybody will start questioning as to whether the mutual funds, the institutional investors have exercised their stewardship responsibility or not. And all of us have a desire that they can exercise and they should exercise the stewardship responsibilities. And that's the reason why I'm saying that they can do certain things to improve the stewardship discharge. What I'm saying is, the investment function and the stewardship function should be segregated. Voting function and monitoring function may be clubbed together. SOPs, that is standard operating procedure for monitoring, engagement, intervention, should be very clearly set up instead of just leaving it to the individual officers. Maintain a conflict register so that in case of necessity, we can always show how he behaved in a conflict situation. Keep a record of the engagement of the company. Take care not to transact with the company shares during the engagement period, or if there's a need to transact in this company shares, see that the engagement is made public by yourself or by the company, so that no allegation of insider trading can be stuck upon you. And then a lot of monitoring is happening all by the stock exchanges because of the quarterly filing of various returns. See what all information can flow automatically. See if you can actually use some technology to see that they download these monitoring triggers from the stock exchange and convert them into monitorable actions for your purposes. Can we use technology here? Can we have an industry group to create stewardship advisory body within AMFI, so that there's always a collaborative approach is institutionalized instead of waiting for case-to-case basis? And then hold periodic meetings with the mutual funds and within group companies. For example, we have one company which is a mutual fund, and there's a investment banker in the company, in the group, and the insurance company in the group. Can the mutual fund and all these institutional investors within that group meet at a frequency so that they can share the common concerns they have as companies are concerned, and they can actually involve into better monitoring, better intervention, and better approach to stewardship responsibility? I'm thinking that this stewardship responsibility uh, given by the uh, SEBI's circular is a very interesting responsibility. We have to see how it actually grows over a period of time and see that we take advantage of this particular stewardship responsibility. This is where I would like to stop this particular session. If there are any questions, I can take them.
Thank you, sir. There are a few questions here, sir.
Okay.
One of them is from Mr. Venu.
Yeah.
What is the benefit of stock market for society? 99% investors in stock market. Losers? This is
Yeah.
what.
I
Yes,
have
sir.
a lighter answer to this question. People who lose, people who lose in the stock market may talk loudly. People who gain from the stock market don't talk loudly. That's the reason why you feel 19% investors are stock market losers. I do not actually agree with this. The point is that what is the basis on which you are making investment, that matters a lot. Are you an aware investor? Are you investing on the basis of your understanding? If you are going by your understanding, yes, you should invest and you will make money out of it for sure. There's no doubt about that. Stock markets have the larger function of what is called as channeling investments into efficient companies. That's what they do. When you try to sell shares of a company and put that money into another company's shares, what you're doing is, this company is not doing well, I want to sell the shares, I want to put money into the other company because it's working well. At that point in time, you have evaluated these two companies, withdrew the money from a bad company, put money into a good company from your understanding point of view. Your understanding may not be final for the market may have its own evaluations, but what I'm saying is, it's a continuous channeling and rechanneling of investments from inefficient companies to efficient companies. That is the kind of a purpose that these stock markets generally discharge. It's a required for any country to grow.
So
uh,
there's another question that we have from
mhm,
YouTube Live.
mhm.
Do you suggest that the mutual funds should go to proxy advisory firms? Will that help in better corporate governance?
Okay. The proxy advisory services firms are specialist firms who, based on the publicly available information, they evaluate the corporate decisions placed before general body meetings and suggest whether they should vote for or against a particular resolution. They are specialist functions. If the AMC does not have a bandwidth to do this kind of work within themselves, they can take the services of proxy advisory services. It's like this: whether you would like to go for a walk every day, or you want to go to a gym under an instructor, that's your choice. But all of them suggest the same thing, work for the same kind of a purpose. Purpose is to see that every proposal brought before the general body meeting is well analyzed and a educated, informed view is taken for voting for or against a particular decision. There's nothing wrong in going to proxy advisory services.
Thank you, sir. So there's a question from Mr. Harshit. Sir, how can a retail investor in mutual funds ask questions to AMC? Is there any procedure?
Yes, there's a procedure. There are two ways in which it happens usually. What happens is, you can send, there is investor services department in every mutual fund, every AMC, and therefore you can always ask a question saying that, oh, I've invested in this scheme with this was expectation, it's not meeting my expectation. That question you can ask. In addition to this, mutual funds keep on making disclosures about various schemes at 6 months frequency, annual frequency, etc. On the basis of these reports, you have any questions against the mutual fund, you can ask them. There's the investor services department, there's the investor services officer for every AMC. You can dial in and ask these questions. Depending upon the questions you ask, they may want to come back and advise you or answer your questions. But asking question AMC is not a big deal at all. Investor services officer is the person to whom you can ask the questions.
So we'll take another question. That will be the last question, sir.
Okay.
Sir, it says by Mr. Venkatesh, would it help if IDs are engaged closely with institutional investors?
Actually, IDs are important pressure group within the board, and the mutual funds and stewardship code, if they discharge the responsibility and try to engage with the boards, I am sure IDs views will get strengthened because institutional investors are also raising similar questions. It may be very good work to do, but I'm not sure whether mutual funds will be able to have an access to independent directors personally unless they know them personally. And therefore, through the questions and engagement of the institutional investors, they can trigger action and thought processes among the individual independent directors, and that's so probably we can try to galvanize or create a collaborative effort in bringing better corporate governance in the country. Yeah.
Thank you, sir. Thank you so much.
Yeah.
And it was a wonderful webinar. We all enjoyed it, and it was very, I would say, knowledgeable.
Okay.
Thank you so much, sir.
Thank you.
Thank you to all our online viewers.
Thank you.
Thank you.